Okay, hello, this is Darwin German, and I am proud to introduce Ben Mandelstein, who is our newest co-sponsor, and he's going to be the co-sponsor on our property, Village Condominiums, which is a great property we're buying in Waco, Texas. And Ben has been working closely with our team for, I don't know, about 8 months. And has been very involved in working with Julian quite a bit, and we are real impressed by everything that he has come up with so far, his business acumen, how quick he's caught on to everything that we're doing, and we're thrilled to have him. And he has got some very, very big news at the end of this presentation that he's going to want to go ahead and tell us about. So he can save the good news, but let's get into our financial analysis. And Ben, anything you want to add?
Yeah, thanks, Darwin. I've been looking at deals with Julian for the last 4 or 5 months or so. I've learned that sticking to a very conservative underwriting is very important. There's lots of properties we've seen trading for over $130,000 a door in Dallas. So to get this property, a solid B class at $95,000 a door, with very large units, all the units being 2 bedroom, average 1060 square feet, really think it's a great opportunity. And by looking at all the other properties that we've gone through, I've been able to compare, how much better this property is, and why it's so important to be very conservative in our underwriting. So we see lots of other groups out there that are, being aggressive to try to make the deals in Dallas work. But we think this is a fantastic opportunity here in Waco. The fact that Darwin has so many different relationships with brokers, different sellers, is awesome that we were able to get this off-market deal. We were able to buy it directly from the seller, get a really good price per unit, large, big units, great location, right off I-35 frontage road.
Village Condominiums is located right on I-35 in Waco, Texas, actually adjacent to Baylor University. So it's got a great location. It was built in 2 phases, 1982 and 1984, and it was built as condominiums. So they're all individually owned. So this is a fractured condo deal of sorts. The condo documents actually say that if 90% of the people there want to sell as a portfolio, then the HOA can sell the entire property as one apartment community. So that's exactly what happened. Is the owners got together and voted to sell it all as one community. So we're buying a fractured condo deal, but we're buying all the units at one time, so it is an apartment. The problem that we have with that is that agency debt needs operating history. Well, we don't have operating history because it's not an apartment complex. It's condos that are individually owned. So we're buying this entire property from the HOA as a value add deal with some hair on it because of this HOA situation, but we don't have any operating history, at least not for all the units together, so we can't get agency debt. So we're going to do a bridge loan, and then after 12 months, refinance it, take some cash back out of it, and then hold it for long-term cash flow. The location is great. Like I said, frontage on I-35 and adjacent to Baylor University, and right next door are some brand new apartments that were built. So this is a great deal, and I'm excited to tell you all about it. Okay. Again, this is Village Condominiums in Waco. We're paying $10,306,000, which is $95,000 per unit. Closing costs are $500,000. We're putting $800,000 in capital improvements, putting $94,000 in our operating account, and we're going to do, the lender is requiring a reserve amount for the time when they have their loan. So we are putting a $100,000 reserve loan in there, which will pay 12% interest, secured by the LLC, not the property, which we've done numerous times. $7.9 million loan minus the $100,000, capital required 3.8. So we're all in on this thing at $109,000 per unit. We are projecting a 16% per year return for the investors. The sponsor, Darwin German Real Estate, sponsors, the Class B members will get 10%, sponsors get 10%, and the guarantors get 5%. And there is a brokerage fee of 3%. Our bridge loan is at 4.85% interest, and it's actually a 5-year bridge rather than 10. So that's Doesn't have any calculation problems with there, just didn't update the 10 years. Because we're going to go to a Freddie refi after 12 months, and that'll be about a 10-year loan at $8,456,000. So we'll have a cash out on that, and let's take a look at how we come across those numbers. First and foremost, they're all two-bedroom units, from flats to townhouses, 108 total units, average square footage 1,060, so good size units. Current average rent is $990 per unit, or 93 cents. We are projecting that we can raise rents with minimal updates to 1,018. So not a big jump, $28, which that would be a normal rental increase anyway. So 96 cents a foot. Now the market is actually $1.04. So we are still projecting well below market rents because we want to make sure that we can achieve our numbers. We're going to do interior updates, $540,000, exterior paint and wood, just a touch up, fencing, landscaping, signage, plus we have $200,000 for extra stuff in there right now. Again, beautiful property, B+, 3 stories, individual HVAC, electric, and hot water heaters, pitched roofs, and built in the 80s. So we're real happy about buying this asset at that price. Now, this is a little skewed. The current per owner that I normally put in there, that's not accurate because they're individually owned, so we don't have all of the expenses. So we extrapolate based on a budget that we did. Our management team went in there and did a budget. Now, the big item here, first off, we're budgeting at 12% vacancy and collection loss, $275,000 in other income. Now, I will say that our management company put in $300,000 in other income. This is RUBS and an internet package that we're installing, but I backed that off a little bit at $275,000. And that's because of rubbing back the utilities, which should be done, which they're not, and also adding that internet package, which saves them money on internet and television and makes us money at the same time. We're doing it portfolio-wide. Especially with COVID, work at home, everybody needs fast internet, and they all want it cheaper. So that's actually going to save them money. We have all of our expenses. Now, this is the big thing that gets me is $7,200 a door in expenses. I think that's high, but with property taxes at $185,000 and utilities at $140,000, those are 2 biggest expenses. Now, utilities right now, if you take the existing bills, it's about $160,000. The current owner, right now, while we have it under contract, is going through and doing water savings program that's projected to actually lower that to $120,000. But again, in my models, to stay conservative, we're using $140,000 on utilities, and $120,000 is what the utility company thinks we'll be spending after we do those savings. Net operating income, $658,000. Thing gets me on that one is based on based on our projected income and projected expenses, NOI, our cap rate is 6.4%. Cash return year 1, 5.4, and that's our current numbers there. Let's extrapolate that and take that out 5 years. Okay. I didn't budget any rental increase year 1 and only a modest 3% per year on income increase, which is less than $30 per unit per month. So a very modest increase. Expenses going up 2%. Now we have a vacancy of 6% and year 1 collection loss of 6%. And then we're taking that down to 3 and then 2. So we're looking at an 8% vacancy and collection loss years 3, 4, and 5. Management fees are in there at 3%, just like normal, and Darkware Management Group will be managing the property. We've already done our due diligence, already created our budgets. We're ready to go on everything, just waiting for the lender for the final push. So the big thing that you want to see, because all this does is that just increases expenses 2%, increases the income by 3%, gives us net operating income. We're going to take from 658 to 830. Company expenses, that's tax returns, asset management fees, things like that. Reserves that we sock away for extra CapEx, recurring CapEx, et cetera. Paying interest on our reserve loan for year one. Debt service of $383,000, which that's before the refi. After the refinance, it goes down. So our actual cash flow goes up pretty dramatically, and that's with $387,000 in proceeds. So the value to 6 cap, which I think is pretty dang high, probably going to be at a lower cap rate, even though it's in Waco. 70% refi, our cost, pay off our loan, we'll have $387,000 to distribute out to partners. Now, I did a year 5 value at close to $14 million. So we still got another $1.8 million to go up over those 5 years. I think these are easily obtainable numbers. The big part everybody wants to know, what do I get? And that's what we put right here. This is what the property is planning on doing. Cash flow year one, $192, then cash flow $382 plus the refinance proceeds of $387, so $789,000 back, and then cash flow moving ahead. But an example, if somebody puts up $100,000, the cash flow they can expect 4.3% year one, 8.5 year two plus $8,600 in refinance proceeds. So $17,000 back, so 17% return year two. Then it turns their cash flow into 9.5, 10, and another 10 plus the sales proceeds. Gives us an overall return after return of capital of 16% per year. You want better cash flow? Here's what a $300,000 partner would get. Invest $300,000, you expect over $1,000 a month year one, and $50,000 in total proceeds in year two. So we think that is a very good return and a good solid 80s construction property. And this is one of the other things that I like to look at. Okay, we are only budgeting our year 5 value right here at $128,000 per unit. Okay, that's pretty low for a B quality property, 80s construction in Waco, $130,000 in 5 years. So I think we're going to be able to beat that number. Our all-in is $109,000, so we're increasing it by $20,000 a door. And since our down payment, our total cash investment is $35,000, that's 50%. The 5-year value is $128,000 per unit, and our all-in is $109,000. So we're planning on raising this $20,000 per unit, and I think that over 5 years, that is a very low number, a very conservative number. So overall, if you're looking for good cash flow with some value add and a cash out refi, then here is the deal.
Thanks, Darwin. Yeah, that was a great overview, and really excited about the deal. I think we're being very conservative, as you mentioned. One of the things I wanted to bring up is exciting news. We got back the appraisal, and it actually came in $364,000 higher than our purchase price. And in commercial investing, they do also not just a current market value appraisal, they also look at our rehab budget and our rehab plan. And they did an after rehab appraisal, and it came in at $760,000 higher than our all-in cost will be. So, that the 16.1% is not including this new news we got. So I think, again, we're being very conservative. I think, if everything goes as planned, we can definitely exceed the 16.1% projections. So if you have any questions, please reach out to me at ben@darwingerman.com. My phone number is 512-970-1223. Really excited about this deal. Me and my family are personally putting in $230,000. Fantastic opportunity, great B-class property, large units, great location. So please reach out. Love to have a conversation with you on why I think this is a great deal and explain our business plan.
Thank you very much for joining us. We're excited to have Ben on the team, and this will be absolutely awesome. Reach out to Ben, give him any questions. Let's go ahead and test his knowledge on that. So reach out, talk to him. He can tell you all about it, and love to have you on the team. Thank you so much. Bye.